At some point, every serious trader goes through a losing streak. Not one bad trade, not a rough week. I'm talking about a sustained period where losses compound, confidence erodes, and decisions start to feel unreliable. Most traders respond to this by changing things, switching strategies, adjusting indicators, looking for a new setup, doing more. But here's what I've come to understand after years of position trading. A losing streak is rarely a market problem. It's almost always a process problem. And that distinction matters enormously. And in this video, I'm not going to tell you how to recover fast. I'm not going to give you a formula or a shortcut. What I'm going to do is explain what a losing streak actually is at a structural level, why it happens, how professionals think about it, and where the real breakdown usually occurs. This video is about understanding, not execution. If you want a complete framework, I'll include a reference to our canonical article at the end, but for now, let's build a foundation. A losing streak is a sequence of losses that exceeds what your trading system's normal variance would predict. The last part is very important. Every trading system produces losses. That's not a streak, that's just how trading works. A losing streak is when losses go beyond what your edge, applied correctly, should produce. So, the first distinction is this. A losing streak is not the same as a bad strategy. Those are two very different things. A bad strategy fails consistently because the logic doesn't hold. A losing streak occurs when something disrupts the proper application of a system that otherwise works. And that interpretation can come from many places. Market conditions are shifting. Rules are being bent slightly over time. Decision-making quality degrades under pressure. Any of these can produce a stretch of losses that feels inexplicable, but isn't. What a losing streak is not. It's not proof that your approach is wrong. It's not a signal to start over. And it's not a verdict on your ability as a trader. It is feedback, specific, recoverable, informative feedback, if you're willing to read it clearly. The error most traders make is treating the streak as a conclusion rather than a signal. They either abandon their approach entirely or they double down emotionally and start forcing trades. Both responses are wrong and both make the streak worse. Understanding a losing streak actually changes how you respond to it. And the response is where the real work happens. They exist because trading involves probability, and probability produces variance. Even the most disciplined position trader with a statistically valid edge will experience stretches where the outcome cluster on the wrong side. That's not failure, that's math. No edge wins every time, and over finite samples of trades, sequences of losses are guaranteed to occur. But that's the mechanical side. There's also a behavioral side, where losing streaks stop becoming statistical and become structural. When a trader's execution drifts, even slightly, from the rules of their system, the edge begins to erode. Entry quality degrades, risk sizing becomes inconsistent, exits become emotional, and the process that the system depends on no longer fully exists. This is how most losing streaks actually deepen. They may begin with normal variance, but they extend because the trader's response to early losses includes new variables that weren't part of the original system design. So, you have two distinct causes that often overlap: natural statistical clustering and behavioral drift, which compound the problem. The reason it's important to separate these is that they require different responses. Statistical variance requires patience and structure. Behavioral drift requires diagnosis and correction. If you treat both the same way by just waiting it out, you may be ignoring a process problem that will continue until you address it directly. Losing streaks exist because markets are probabilistic and humans are reactive. Understanding that combination is the starting point for everything that follows. I don't think about losing streaks the way most traders do. The instinct response to a streak is to focus on the losses, to revisit every trade, replay the entries, and try to identify what went wrong in the market. I focus on the process, not the outcomes. A professional trader understands that any individual trade or any short sequence of trades tells you almost nothing definitive about your edge. The sample size is too small. What those trades can tell you is whether you followed your process. And that's the diagnostic question. Did I execute according to my rules? Not, was I right about the market? If the process was followed and the losses still came, I accept that as variance and I continue. If the process was not followed, if rules were bent, if position sizes crept up, if setups were taken outside defined criteria, that's the actual problem, and it needs to be addressed before the next trade. I also separate confidence in my system from my current results. These are not the same thing. A system can be sound even when producing its losses. A trader's job is to execute the system well enough over a large enough sample for the edge to express itself. This is a fundamentally different relationship with outcomes. Most traders let results determine their confidence. I let process quality determine my confidence. The most common misunderstanding is this. Traders treat a losing streak as a technical problem when it's usually a structural one, because the losses show up in the charts, in the entry, and the exit points. Traders look there for answers. They study the price action. They re-examine their indicators. They wonder if the setup was valid. And sometimes those reviews are useful, but they're looking at the symptom, not the cause. The cause is almost always upstream. It lives in the quality of decision making before and during the trade. It lives in whether the rules were followed precisely or approximately. It lives in risk sizing and whether emotional pressure began to influence position management. Another breakdown is the belief that a losing streak demands immediate action. This is one of the most destructive instincts in trading. The urgency to fix something quickly leads to change that haven't been tested, setups that don't fit the strategy, and risk-taking that escalates rather than resets. Slowing down is counterintuitive under pressure, but it's actually the correct thing to do. A losing streak is not a crisis that requires an immediate response. It's a signal that requires calm, systematic review. There's also a tendency to isolate the problem to the most recent trades, when the real pattern may extend further back. Traders look at the last 5 losses and miss the behavioral drift that started 3 weeks ago. This is why regular objective trade review, not just post-loss review, is part of a functioning process. The breakdown in understanding is always the same, reacting to outcomes rather than examining process. This concept fits very clearly within position trading because position trading is built on low frequency and high process quality. When you're trading fewer positions over longer time frames, each decision carries more weight. And that means process integrity matters more, not less. It also means that when something drifts, it takes longer to surface and can cause more damage before it's caught. Losing streaks in position trading are often quieter than in shorter time frame trading. You may not notice the drift until you've had 4 or 5 bad trades over several months, but the structural cause is identical. The process has been interrupted and the outcomes are reflecting that. When losing streaks do not fit into position trading, they are a signal to shorten your time frame or trade more frequently, and this is a common mistake. Traders under drawdown pressure sometimes migrate towards shorter charts, thinking more activity will create more opportunities to recover. This is behavioral, not strategic, and it almost always makes things worse. The strength of position trading is that it keeps you away from the noise. It requires fewer decisions and allows more deliberate execution. A losing streak should push you deeper into that discipline, not away from it. The concept also doesn't belong in a vacuum. Understanding losing streaks is only useful if it's embedded in a complete decision framework, one that includes risk rules, trade criteria, review processes, and performance monitoring. Treating the streak in isolation without the surrounding structure leads to arbitrary changes rather than meaningful ones. A losing streak, understood correctly, is one of the most useful things that can happen to a serious trader. It forces a process review, it reveals where structure is missing, and it tests whether your discipline is real or situational. The traders who recover well from streaks are not the ones who find the fastest fix. They're the ones who slow down, go back to fundamentals, and ask honest questions about how they've been executing. And that requires patience. It requires a willingness to accept that the market isn't the problem right now, the process is. And it requires enough long-term perspective to separate a difficult period from a permanent condition. Your edge, applied consistently and correctly over time, is what produces results. A losing streak does not eliminate your edge. It usually just reveals where the application broke down. If you want the complete 5-step framework for working through a losing streak, including how to reset your rules, stabilize your decision-making, and return to consistent execution, the full article is linked below. It covers everything in the detail that this video can only introduce. And you can read a full article at positionforex.com. Again, the link is in the description. Until next time, best your trading.